Welcome to Investor's Guide and thank you for tuning in. Now this is the show that helps you through this entire investment market and finds the products that suit you best. We have less than a week to go before we hear the first union budget announcement from our brand new government at the centre. What can you expect from that budget announcement? How will it affect your money? That's what we're discussing this week. Remember, our email ID is at the bottom of your screen where you can get in touch with us and ask us any questions you have about the budget. More importantly, on Budget Day, we'll be going live from the ET Now studios in Mumbai on Budget Day at 7 p.m. in the evening. If you'd like to join us in the studio, write to us as well. We still have a couple of seats left in the studio among our audience. It'll be our pleasure to have you here where you can ask your questions live. Well, let's get straight to it. Over the next half hour, we're going to try and figure out what we might hear in this budget or how much room the finance minister has to make life easier for you and me. And to help answer our questions, Pranav, partner tax at Ernst & Young, and Dhirendra Kumar, CEO of Value Research. Gentlemen, thank you so much for joining us. Pranav, I'm going to start with you. The finance minister right now finds himself inheriting a slightly weak economy. It is possible that he has right now bigger problems than direct taxes to look at. How much room does he have to give us more money in our wallets this year?
I think we have to be a little more patient for the chip-in, quote-unquote, to really come in terms of tax stops or immediate benefits. Given the state of the economy, I think his primary goal right now will be to rein in inflation expectations and to get the fiscal condition completely under control. So I would not expect, and I do not think it is fair to expect some large tax swaps immediately in this very budget itself.
All right. Dhirendra, I want to bring you in here now. The bigger question here is that this government whipped up so much optimism during the elections, and people are going to bring this optimism into what they expect from the budget as well. Is it going to be a tightrope walk for the finance minister to still continue somehow to keep that optimism alive?
Yes, absolutely. But I think, on the optimism front, I think we have reason to expect something substantial. We are getting this government in its current form, in a configuration. We haven't seen it before. Ever since I grew up, I never saw a government in this form. So from that standpoint, I expect that a government which will act responsibly and do the groundwork for that. So in that sense, I have huge expectations from this budget, not tangible stuff, but fairly clear roadmap, the way it conducts, the way it states, and possibly, if the whole, a good part of the budget gets converted into, easy to digest, easy to absorb bullet points.
But I want to ask you about the same thing. If we're looking for a tone or we're looking for a roadmap from this budget, what will you be listening for when you hear that announcement?
So the way I look at this budget is that this budget will set the tone, as probably Dhirendra also was alluding, to a long-term strategic direction for this economy as a whole. And that is, I think, what one should look for. This budget will be an excellent budget if one is willing to give up a little bit in the short term, but have large expectations for the long term. And if that expectation
so give me an example of what this give up will have to be in the short term, or what may be, and what the large long term expectations are.
So, for example, I would be very, for example, elated if it is very definitively told that surcharges will go next year, or the tax rates will be brought down in a certain manner, or that the threshold will now clearly be benchmarked at least at the inflation rate. Very clearly the fiscal deficit is completely reined in, and there's a clear commitment of how the fiscal deficits will be over the next few years. There is a clear direction to ensure that financial instruments, savings in financial instruments, is going to be encouraged, and that real interest rates will always be above the nominal inflation rate or whatever, and so on. So these are the kind of things I would feel one should expect in a major way. Yes, there will be some immediate stops as well to encourage financial instrument savings and so on, but those will be the room to maneuver, the room to offer immediate benefits, I think is fairly limited. And my feeling is the more important thing right now is to get fiscal deficit under control and to get inflation expectations completely reined in. And this is the year where I think he has repeatedly said that the economy is in a shambles, and therefore we do need to give up something in the short term for a more longer term benefit for the country economy as a whole and for the people at large as a whole.
Well, Dhirendra, that's one of the expectations from a lot of analysts, that this government will be willing to make those tough decisions, willing to stand their ground when it comes to making these tough decisions. Now, as a regular investor watching at home, if I'm watching the budget announcement on Thursday, what do you think I should be looking for? What will give me a clue about whether or not this government is willing to make those tough decisions?
I will have 2-3 expectations. One is that, having a scientific framework, every year we look forward to the budget giving us a dole in terms of, revising our limits. That can well be, inflation linked. And even if we don't get it in a tangible way, if we get a roadmap on that front, and, government has the wherewithal, particularly income tax department, which comes out with, every budget we come up with its cost inflation index. So that getting revised. So in that sense, that will be adjusting our tax rates to inflation. And that will be a very fair expectation. That apart, simplifying our mechanism. Every year we have tried that, a Saral form which is no longer Saral, or the complications, or, it took 2 years for us to understand that, unless we exempt that up to 10,000 rupee interest income on the savings bank deposit. So, for common citizen, encouraging him to comply with tax laws and simplifying it, making it, as simple as not doing anything, and it's taken care of. That's another. From that standpoint, DTC started with a very ambitious target, and eventually it turned out to be nothing different. And so much so that I don't even look forward to DTC causing any difference. I will be looking at, these 2-3 things, nothing beyond this.
Well, Pranav, we've talked about DTC before. You and I have been talking about it now for 5 years? So, like Dhirendra said, if all of that is going to happen now, it basically means going back to the drawing board with DTC. Do you even expect a mention of DTC in this budget?
Honestly not. I don't think there's too much left in the DTC which really can make a transformational change or a difference. Once again, like Dhirendra said, what I feel is most of the real stuff in the DTC has either already come in indirect transfer, GAR, and so on and so forth. What is now left of the DTC does not really make any dramatic change to our lives from the current Income Tax Act. So if one wants to really look at a completely different income tax regime and start from scratch, then I think one will have to look at something altogether new. The name can still be the DTC, that doesn't matter. But it will have to be relooked at completely from the start in order to be able to make any difference to the lives of the common man, really.
But I will agree with Dhirendra here when he talks about the fact that our current tax system is so complicated because you are considering all of the tax deductions that you make, and then every investment. I know that a lot of our viewers don't even know that if you have a fixed deposit for 5 years, you still have to declare the accrued interest on it every year and pay tax on that, even though you're not taking that interest home. How much of it is a need of the hour at this point for us to simplify that tax system so that investors and common citizens can take advantage of it?
Right. I have a slightly different take on this. For a country our size, our diversity and our complexity, it's not going to be very easy to completely simplify the tax law. I think the real need to focus, the area to focus on, is the area of administration of the tax law as such. So if we can get a fair, reasonable tax administration, if we can get a tax administration which is made accountable, for which, fairness, reasonableness, giving quick refunds, not making unnecessary additions, not dragging people into litigation, also ensuring that it is as clean and transparent as can be, that will make a huge difference. Alongside educating people and making the forms and other stuff simple. But other than that, there will have to be some form of complexities in the tax law. I do not see any country or any economy which is large enough having an extremely simple tax law. That's going to be tough. I think it's more a focus on educating people and having a nice, clean, efficient administration.
Alright, I want to ask you this straight off. There's a big demand right now that Section 80C that currently allows us 1 lakh rupees deduction be doubled to 2 lakh rupees. Do you believe that might happen in this budget?
Honest answer, I don't think so. I don't think he has that kind of luxury to be able to double it. I would be, in fact, extremely happy even if it is increased by half that amount.
For Welcome back. You're watching Investors Guide in ET Now. This is our budget expectation special. We're trying to find out what we can expect to hear from our new finance minister. Dhirendra, one of the big things that this government has to worry about is the fact that household savings, which is the money that we all save at home, is not finding its way into long-term equity. It's not finding its way into sectors like infrastructure that really need the money. How do you think this government is going to tackle that problem? Is it going to find a way to give us more tax breaks to encourage us to invest our money?
No, that will always be a very short-term solution. We have seen such experimentation in the last 4 or 5 years. First we had this, ATCCS. Now we have these infrastructure bonds which people can buy, and the interest income is completely tax-free. But all these things, they're quite ad hoc arrangement. Unless until we make a systemic change that there is a long-term savings, in a gradual way finds its way into long-term investments, and infrastructure is a sizable allocation of it. In fact, we have a big systemic problem. Our long-term savings of citizens in this country finds its way into fixed income, and that is primarily government bonds in some form or the other. It's really funny that we have private sector employees whose money is managed by EPFO finds its way entirely into fixed income, and government employees' money largely into fixed income, but also managed by the private players, in the NPS, the new employees. And old employees of government, they are the guest of the taxpayers. So in that sense, that's the taxpayer's liability. And that is a very large defined benefit system. So in that sense, we need to really overhaul this system, at least the discretionary thing ever since, 1st April 2004. We started this system, and it is very mismanaged. It is very well ill-organized, mismanaged to some extent because it did not start on time. And it is just the wrong thing to do. Long-term savings finding its way into fixed income, and which by design makes investors think that equity is for the short run and it's an opportunistic investment. That has actually caused serious damage to the investment culture in this country, and that needs to be fixed. And I don't think it can be done quickly. Any ad hoc concession or incentive, I don't think is sustainable.
Well, Dhirendra, we know that earlier this week, SEBI put out a notice saying that they have asked a committee to consult with them and let them know how they can bring in more retail investor money for the long term into the equity market. And this is one of the problems, the fact that SEBI right now manages mutual funds. You have a different regulator managing all of the pension products that you just talked about, and they might not necessarily be working together. Is there a need perhaps also for this government to consider streamlining all of the regulations that manage our money right now?
Yeah, absolutely. Harmonizing the regulations for different segments, because there are two ways of looking at it. Right now our regulation is structured along the lines of product. But I think, regulations need to be structured along simply in terms of ability to regulate, and harmonizing it and looking at investors as consumers and their interests be protected. And with the financial markets becoming sophisticated, I think the institutional knowledge which is getting fragmented at different regulators, I think there is a serious need. And the investors don't differentiate. When a customer is buying, when an investor or a citizen is buying a ULIP, or he's buying a mutual fund, or he's buying a bond, or whether he lands into a chit fund scheme or a fake chit fund scheme, he doesn't care who, eventually it's the government's responsibility to ensure that, what investors are getting is a legitimate, well-regulated, and offered by somebody who is not a fly-by-night operator, and is well-regulated and is in a reasonable health, or customers understand the risk. That is not possible. It is not possible to harmonize everything when we have multiple regulators.
So obviously there's some need, Pranav, there to bring in, some sort of harmony when it comes to regulation, and of course to encourage more money into long-term equity or long-term investments. The other really long-term investment that we have in this country is that of real estate. The fact that we all want to buy homes. This is a promise the government has made to us, a home for every one of us before the 75th year of independence. 20 million urban homes, that will be 60 million rural homes. Is there some way to tweak the tax system to allow us a larger deduction for home loan interest repayment or home loan principal repayment here?
Right. So I do think that the interest deduction for self-occupied houses is something that probably should go up, and that's something that I really expect from this budget. That will also ensure that there is a fillip to savings and investment in some sense, because it promotes that. Plus, it ensures that the real aspiration of having a home for every Indian is somewhere fulfilled. So I would feel that's a big expectation that one can say could get fulfilled in this budget.
Alright, so Dhirendra Shaw has written in, he invested 2 lakh rupees in the Tata Indo Global Infrastructure Fund in 2007. He wants to know what to do with that investment right now. The reason why I'm bringing this up is obviously there is an expectation that this government will be pushing infrastructure in this budget. They will want to restart that sector altogether. For those of our viewers, like Dhirendra, who have invested in infrastructure funds, do you expect good news going forward?
I would say that, it has been too long a disappointment. This fund started in 2007, sometime in the end, and it has struggled. It is just trying to break even with its face value. It is getting close to 10 rupee today, somewhere close to 10 rupee now. And it has made a good recovery. It's up about 35% in the last 1 year. And I have always held this view, even in the boom time as well as the lean time, that, you are not deprived of anything if you are not buying an infrastructure fund. Investors' lesson from all that has happened in the last 5-7 years is that they should take the diversification to their heart. They should be investing regularly, accumulating their savings, and if they don't do these two things, they are in for nasty surprises. And that could sometimes be, nowadays it may not be nasty, it could be pleasant. But it will be it will be actually a big compromise on the way you save, and you will not be able to benefit from it.
I'm going to put on the screen right now the equity diversified funds that we recommend on the show. You'd be better off investing in one of these funds. So it makes sense to pull out of infrastructure or any other thematic funds that you are in right now and take an equity diversified fund. I have a tax question for Pranav. Amit has written in. He wants to know what the tax liability will be on a salary earned abroad, transferred back into India. He spends more than 250 days a year overseas, which obviously qualifies him as a non-resident. He also has some Indian stocks that have made a profit. He wants to know, will he have to file his tax returns in India for stocks held for more than 1 year? So 2 questions there. One is the salary is coming back every month, and there is a profit on the stocks that he hasn't sold. So it's not realized yet. What will he have to do?
So in regard to a non-resident like Amit, if he has earned salaries abroad and has received those salaries abroad, he is not taxable in respect of that salary income in India. The mere fact that after receiving the salary abroad from his employer, he remits it into India does not make that salary taxable in India in any way. Because he is a non-resident, there is no question of any tax in India on his salary income. Additionally, if he is in a treaty country, he might have other advantages as well, but at least this seems to be clear even from the domestic law alone. In regard to his investments and incomes in India from those investments, those typically would be taxable, subject to any treaty availability. Under the domestic tax law at least, any investment income that he earns in India, which is of the taxable variety, would be subject to tax. So if his investments were in listed shares or in listed or rather in equity mutual fund units and held for more than 1 year, typically there should not be any income tax on their disposal and gains. But if they are short term, there would be tax, of course. And if he is taxable in India, he needs to necessarily file a tax return. If he has no taxable income in India, he need not necessarily file a tax return.
Very quick question for you. If he's moving his money every month to India, would it be better for him to just use an NRE deposit? Would that be more efficient for someone like him?
Oh, absolutely. And I assume that his monies would be in an NRE deposit to the extent he's moving his salary income here. But again, it's a function of whether the deposit should be in a rupee account, So that would depend on also the nature of his profile, whether he wants to diversify, invest some amounts in equity and mutual funds and so on as well. But yes, to the extent it is in NRE deposits, there's clearly an advantage that he has from a tax standpoint.
Right, welcome back. You're watching Investors Guide and ET. Now this is our budget expectations special. We're preparing for the big budget announcement that we're going to hear next week. Pranav and Dhirendra Kumar are in the studio with me. Pranav, I want to very quickly ask you, are we expecting any announcement on gold at all in this budget, or is the budget not the space to make that announcement?
Well, I'm not too sure that there'll be some tempering of the import duties in respect of gold. I think they'll probably wait for a little while. The US tapering is still happening. And while the current account deficit is the one good thing which is quite under control right now, I'm not too sure they'll want to rock the boat just as yet.
All right. I also want to ask Dhirendra very quickly, we heard the announcement of inflation-indexed bonds last time in the budget. It hasn't really picked up since then. Do you expect maybe it will be tweaked a little bit or mentioned one more time just to give it a little more interest among those who are listening?
I hope that, government takes a closer look at, these inflation-indexed bonds. Leave aside the back-end technicality that, the savings mobilization, what percentage is, accessible to state government or central government or whatever. But, the interface of the citizen or any common man is with the government, that he's buying something with a sovereign guarantee and it has a, ABC feature. And in that sense, this inflation index bond is excellent. And I'm not expecting any magic, but, mechanism to channelize long-term savings and simplifying things the way we interact with the government, these are only two things which I'll be looking at.
So, Pranav, that's ideally what every Indian would like, an inflation-indexed investment with a tax-free return. Is that too much to ask for?
I'm not saying that it's asking for too much. If to the extent there is inflation, to that extent if you are not taxed, and only the real rate of return is taxed, I do not think a taxpayer minds paying the tax on the real rate of return. So to the extent the interest of the income is inflation wiped out, there should not be a tax. And to the extent there is a return over and above the inflation rate, that real rate of return can be taxed at the normal rates of tax. That's something that is a fair ask, I think, from a citizen. Especially where year after year after year there is double-digit consumer price index inflation. I think that's a very reasonable ask.
As we hope the finance minister is listening, that's a reasonable ask. And remember, Pranav said consumer price index, not the wholesale price index. Pranav, I also want to ask you about the fact that his government has said repeatedly that we are a government for the poor. There's also a need to widen the tax net at this point and bring more taxpayers in. Again, a tightrope walk for the finance minister. Which way do you think he's going to go? Will there be tax breaks for the lowest income bracket? Or do you think he will try and include more of them in the tax net?
I think there will be an increase in the threshold, but not to the extent, of course, the expectations have developed over the last few days. But I do think there will be increase in the threshold. I would be surprised if that is anything very significant. I do not think right now there is enough room with the finance minister to be able to give a lot of increase in the threshold or a huge drop in the minimum tax rate, which is presently just 10%. So I would feel there will be just some tinkering around in the basic threshold. Better than what we are used to in the past, but still nowhere close to what the expectations are. I think it's nowhere going to be close to 5 lakhs and so on, which are the numbers floating.
You just think that the bottom limit might be extended a little bit?
That's
all right. Let's ask another very quick question. Nathan has written in, he's been employed overseas since June last year. And he tells us he remitted funds into his resident Indian account before opening a separate NRI account. He wants to know now if he should transfer the amount from one account to another and claim NRI benefits. Is that possible? His bank has told him that he cannot claim those benefits and he cannot undo the transfer. Does it make sense then to convert the existing account into an NRI account and claim those benefits? Is any of that possible, Pranav, now that he's already made those transfers?
Not really. Unfortunately, I think the way the regulation stands, if he brings the money in and converts it into his normal resident funds, it's very difficult to reconvert that back into NRE funds, so to say. What he could probably try is, for a non-resident, there's a certain amount that can be remitted overseas every year, which is quite a large amount. And that's something that he could probably do in terms of remitting the money abroad.
Do you think take the money back?
Correct.
Overseas and then move it into your NRO account? I want to ask you this question because this is something that a lot of our viewers do. They live overseas, they send money back to their parents every month, which might be done through a joint account where you have one card, you have one card. What is the most efficient way to do that? Retired parent living in India, the young working person overseas sending money back home every month. How should they do
Normally, it should be in a joint account where the parent is also an account holder and remitted or wired into the account here in India, which is maybe an NRE kind of account. If there's any reason to reinvest that money. If it's going to be withdrawn, then it doesn't really matter, even if it's an NRO account.
Alright, so that would be the most efficient way to do that. Unfortunately, we've completely run out of time on this show. Dhirendra and Pranav, thank you so much for spending time with us. And of course, if you have questions for either of them, write to us. Email ID is at the bottom of your screen. Remember, We are here on Budget Day between 7 and 8 p.m. in the evening. You can tune in. You can send us your questions live that day on Twitter, on Facebook, or on our email ID. We'll answer your questions as they come in. Tune in on Budget Day to catch Investor's Guide. Thanks for watching.